can't refinance that. So this happens in Indiana. So guess what? The reverse mortgage took her home. Even though I never did it back then. Well, that goes to Diane Sawyer of ABC, whatever, and you can see it takes about a 2-minute little blurb on that, and it makes the reverse mortgage look terrible. And that was a big, now the bank paid your home. That's where that came from. Well, what they did was a couple years ago, they changed that. They changed that guideline. So now the loan's calculated on the 58-year-old, but when I die, as long as the 58-year-old owns my home, the loan waits till she dies to get paid back. So they fixed it. And what I found out is they're even going to some loans where they don't have to, and they're fixing them too for a non-mortgage spouse. So that's where you hear the bank owns my house. No, because it's a lien. The bank can take my house. Yes, that used to be true, but the only way they can take your house is if you don't pay your property tax insurance.
I heard regarding if you have to live in the house
Right.
for that long, but I heard a case that was way back that they end up in a care
Yes,
home
good question.
temporarily, yeah,
Yep.
and they lost the house.
Right, so the way that works is it has to be a primary residence. So how do you define primary residence? Well, for a while, people were going back and forth, and there was even alliance meetings where we'd sit with a HUD person and they didn't know. But the way it's defined now, pretty much accurately, is you have to be in your home 12 consecutive months.
12 consecutive.
Right, so let's say I'm in my house and I have a heart attack and I go in an assisted living place. I go through stroke. I go through that, but I come back, no problem. Okay? Let's say I have a stroke, heart attack. I go in an assisted living place and I stay there. Well, what will happen is when they find out that I've been there for 12 months, then the loan will be due and payable.
But even if you stay for like 3 months in assisted living, you still.
No, not if it's 12 months. Now, here's a scenario which I've heard before. So I'm in assisted living, right? My wife's at home. Well, let's say my kids are at home or something. Now, I get in a wheelchair and they drive me to the house. 11 months and 25 days just for fun. And I spend one night in a house. Technically, I haven't been out 12 months, and that starts another 12-month period. You know what the reality is, and Jack, I know a lot of agents, is typically when you own a home and you have to go to assisted living, the main way you pay for it is by selling the house anyway, right? Yeah. So it's kind of playing games, but remember, you gotta pay the property tax and maintain that home while you're in assisted living. So now if it's a couple and one of them is assisted living, there's no problem but let's say this one is a non-married spouse and that one is there, and what you want to do is let's put them in a van, let's get them one day in the house.
Take them home for Christmas.
There you go. Bring home for Christmas. Yeah. Good question though. Yeah. Okay, negatives. Okay, so one of the things, not so much as least of the costs. The costs have come down. They're not a cheap loan, but it just depends on your specific scenario, how expensive they are. Just because it's a real estate transaction, so there's closing costs and things like that.
Wait, so so talk about that for a second, because somebody did ask that question, couldn't make it, so I'll find out. So let's take a typical loan. Let's say, $600,000 home, they're gonna do a reverse on it. They, let's purchase a reverse, for example. It's the same fees, whatever. They put $360 down. So what are the fees involved in that?
So there are 3 fees.
Okay.
One is an origination fee. Okay, so that's a lender fee.
How much is that?
That is between, depending on the value of the home, between $2,500 and $6,000. Or if the loan is right, the lender will waive it. But the new trend is to use that to buy down the rate, kind of like 4 months do.
Okay, but basically, so what, like between half to 1% of the house value?
So it's that, yeah.
Okay, so that's one.
The second is third-party costs, right? So it's very similar to a loan where you've got title insurance, you've got, fees, doc fees, all those things, closing costs.
What do they come out to?
It just depends. It's a little bit higher than a regular loan.
When you say a little bit higher, typical loan's about 0.75%.
Okay? I'm the kind that I hate telling you something without doing a number on it. But
Okay.
it's very similar to a regular loan,
Yeah, because but you should have some kind of a ballpark. In other words, like, you know.
because it varies, yeah.
Okay.
It does vary. Now, the one that doesn't vary is it's a 2% of the value of the home is the mortgage insurance premium. So just like an FHA loan, there's an MIP. So that's 2% of the value of the home, that's the largest one. So you're looking at closing costs in the range of typically a $600,000 house, probably about $20,000.
Okay. Oh, the mortgage insurance is upfront,
Mm-hmm.
lump sum.
There's a lump sum up front, and then there's an annual of 0.25. That used to be 1.25. In fact, it was 2% before. So there's an upfront, and then there's an annual. The annual is small compared to what it used to be.
No, because
But
so
if you guys
20
are
grand.
interested, I can do that and share it with you, and you can look right at it.
What did you say the annual was?
0.25.
Is that the only ongoing
That and the interest, yeah.
and the interest? That's it. Okay.
Is there a fixed interest rate?
There is. Now, so there's actually three, and I'm talking about Heckman's, okay?
That's the lower one.
The proprietary, they're all fixed. They have one that's a variable, but it's goofy. Because the proprietaries are kind of new. And you're gonna see like 5 years from now, I think more of the market will be the proprietary reverse mortgages. Because every time that the industry is depending on the government, every time they do something that, makes the product harder to sell, well, it's our own fault. So we need to come up with ideas that work, so we're not depending so much on the government. But, I'm sorry, what was your
Interest
question?
rate on the,
Yeah, so, that's right, so the fixed is like 4.5-ish, 4.6. But what they've done with the fixed is you qualify for a lot less than the adjustable. And the adjustable is a 1-year adjustable tied into the LIBOR. And so LIBOR is the London Interbank Order Rate. So it's what these big banks charge each other, okay? Now, the reason why they do that is the fixed only gives you a lump sum option. It says, here's your money. Whereas the LIBOR, the adjustable, gives you the line of credit option. Okay? All right.
What's the current rate right now on the LIBOR, on the variable?
Just did one. I don't know what the current LIBOR is, like 2, I think, I'm not sure. But see, I vary the margin. So
How?
depending on the margin.
Is the margin up to you to vary?
Yeah.
You can play with the margin.
I can adjust it depending on the loan. Yeah.
You
That's
mean,
what I'm doing for a client. That's exactly what I'm doing for a client.
all right.
They used to not be able to do that. That's new, it's new flexibility in it. Okay. So refinance, so it's 2 things we're doing. We're already talking about refinance. About 81% of reverse mortgages now involve a line of credit, so that's really the refinance, is to pay off an existing loan or to set up a line of credit or give money for fixes and such. Line of credit, as I mentioned, we talked about that. Annual rates can be anywhere from 4.5% to 5%. The reason you may adjust the margin is if you want a faster growing line of credit. So it just depends on what your particular needs are. And the thing about the line of credit, and this is interesting, you get a line of credit on a loan, and Katie Karcher is a really good example, is they're immune from market changes. Now, in the day, in 2006 or whatever it was, I had $50,000 line of credit on my home in Chino Hills. And so I was like, well, I got 50,000. I think I pulled like 23 on it. And for years, I didn't touch the rest of it, right? I said, I needed it. Well, as soon as the market did that, that line of credit, poof, disappeared to the remainder amount. That happened to a lot of people.
Yeah.
Well, the difference with this is it's immune from that. So not only, no matter what, not only will it not disappear, but it's gonna continue to grow based on the rate of, and that rate, I'll show you in there, I'll show you an amortization schedule, and that can be pretty hefty, that can be pretty significant. Everybody knows Carl Jr., right? Carl Kircher?
Mhm.
Well, I know Katie Kircher, it's his daughter. And, so I was giving a presentation, I know she wouldn't mind, she gave me the floors and stuff. And, I did a presentation for the chamber, and unknown to me, she raises her hand, she goes, well, here's what I did, and everybody thought I was crazy, is when I turned 62, I got a reverse mortgage, and I set up the line of credit, and I'm not gonna touch it. And I know that if I don't touch it, 20 years from now, it's gonna be worth $1 million. And guess what, it doesn't matter what the house is worth. And even if, so the house probably isn't. So she could have $1 million line of credit on a $700,000 house. Now what happens? Let's say she gets hit by a car, okay? Now her heirs are gonna have to pay off a tiny little loan. They're not getting $1 million, right? Because it's just a line of credit that's sitting there. Like 2 buckets, here's the loan, loan's doing this, and here's the line of credit. And it's like, it could be like 5.5% compounding, 5.5%. But let's say, A, she can draw it when she needs it as a safety blanket, you know. But let's say they say, Katie, sorry, you have, 2 weeks to live or a month, pretend whatever it is. She can fill out a form. They'll take $1 million, put it on that loan, put it in her bank account, and when she dies, her kids now inherited $1 million. They can't touch it, it's non-recourse, right? So the loan's upside down.
Yeah.
They can't touch it. None of that, but they gotta sell it to them at 95% of the value. So they can take the money and buy the house at 95% of the value if they want it. So she gets it. That's how powerful some of these things are if you understand them. Okay, reverse purchase. So a couple of, buy more home, I call it the buy more home strategy. And I do teach agents this, and the idea is you can buy more home with the down payment of a reverse mortgage. So if you take a look at this one here, right, the one for 2, that's the next page, yeah. There you go. So on the left is current scenario. These folks, they have a mortgage, they're in Whittier, $1,950 a month. Their income is $3,300. So their mortgage payment is like 61% of their living to make that payment. It's, so they call me and say, hey Jim, can you pay this off? Well, I can't because there's an equity. So what I did though, is I shared with them, well, if you net 224, they could buy a $420,000 house and not have a payment. They could sell their home, get into this new home, not have a payment, and that saves them basically $2,000 a month, $24,000 a year, and $250,000 over 10 years.
I read somewhere you have to put 50% of the value of the new house, or is that true?
No, what it is that used to be true. At 62, it ranges from
60.
your down payment is 60%,
60%.
and there's ways we're dropping that. Okay, so there you may be able to make you put less down, but you're right, that's the idea. So that's kind of what you're looking at. It is about a 60% down payment. So that's, again, it's what you net from the sale of your house, right? That's how people get big down payments, is selling this one and moving to that one. So especially if you have a 2-story home and you've got a mortgage on it, boy, it sure looks at, and you say, I wanna move someplace, maybe a single-story home, and I wanna get rid of that payment. And you can do that with a reverse purchase. And that's what we did in this scenario. So they're basically living on $1,000 a month, so guess what's happening? Kids are helping them, right? They're doing this stuff. Well, this, now they're living on $3,000 a month and with no mortgage payment. That can work for a lot of people. Next one, the situation, and this one we're still working with the client. Her current payment is $1,800 a month. Her husband died like 4 years ago. Very sad, she's still in mourning. That's just very, some people just react different ways. So, her income is $1,700, so her income is less than the mortgage payment. So guess what she's doing? She's eating up a 401k, her husband's 401k is to meet expenses. Kids are helping, right? And so what we did is we said, well, I forgot what it is. If you sell your house, you could buy something like $339. You could buy like a $700 house. Well, what she was really looking at is, no, I don't need a $700,000 house. I need a house that's around $400,000 to live in Whitney. That's not what you have. Well, what happens is, okay, so we put this money into the house. It's a $400,000 house. She gets rid of this $1,800 payment, and she puts $100,000 in the bank from the proceeds. That completely shifts her financial world when you do that. That's why I wrote a book. When I truly understood this, I thought this is so fantastic. I want to share the word with, because realtors are the ones that, if they know this, can introduce us.
I have a question for you. In this scenario, so the difference on the house after she made the down payment, that she has no monthly payment on, and the $100,000 that you put in the bank will be combined to collect the interest finance charge?
No, okay, let me clarify that. So in this one, what she did was she could buy more house. She could buy like a $700,000, I forgot what it was.
Right.
It was more of a house, but she doesn't need that house. Yeah, so she buys 400. She gets rid of the payment. What does she net on this? What did I say she netted? 339, right? Like 340. So she netted 340, and she only had to put 240 down. So she makes 340. Escrow closes. I got $340,000 sitting in this.
I mean, that was from the sale of her other house.
Right.
So that has nothing to do with the new one. So it's just the 100 that would be sitting in there.
Right. So she takes that 340, and she goes, "Well, I need a house."
Yeah.
So I'm gonna take 240 of that, buy this house. It's a $400,000 house. I don't have a payment, and she just added 100,000 into.
Okay, that's where I was getting the extra money. So she
Yeah.
put 240 down on the $400,000 house. The difference on what the house was and what she put down, that, well, she banked 100,000. She still owes that 160,000 on that house.
That's a reverse mortgage.
And that won't require any payments, but it will accrue interest. So she'll have, that 100,000 was extra from her sale, so it's only 160 on this one.
Correct. Yeah.
Okay.
Yeah. So her 401k went from 105 to 65. So now she could add 100. Now she's got 165. Right now she's negative $100. She's burning a negative $100 a month burn rate. Okay. In the third scenario, who's this one here? Oh yeah, so this is a situation where I met with a client, same thing. Client's looking at a 2-story big house in Hacienda Heights. It's like, well, she's on a walker, and he just had a heart event. So he got this 3,000 square foot house, too much. 2 stories, bad. So, well, can you pay off? There was a mortgage. Jim, can you come in and pay it off? Well, this one I could. So yeah, well, you've got enough equity, like $290,000. They could pay that off and get rid of that payment if they want. But I asked, I said, do you guys really want to stay here? It doesn't look like it really fits the long term. And they say, well, no, we'd like to move, because they realize it. Well, where do you want to move? We want to be closer to the beach. Oh, that's not good. That's expensive. And then the agent says, well, would like La Verona be good? She said, yeah, that'd be great, because I guess you go over the hill and it Hacienda Heights to La Mirada. So let's go to the beach.
I'll take that.
That's,
It's pretty funny. And so then I go, well, you know, if you did that, you get rid of this payment, which is like 1,400. Their income's 7,000, so you go, well, 1,400, 7,000, 20%. That's not like really bad news. And let's do that. Talk about that. But then he goes, well, will this help me pay off my $100,000 in credit card? So he's supposed to 70, and they have $100,000 in credit card. Guess what the payment on that is? That's $2,000 a month.
minimum payment.
Yeah, minimum payment. So now they're $3,400 a month. They've got a $290,000 house loan and a $100,000 credit. They're never going to get out of credit card debt. They're never going to get out of it. So now let's sell the house, buy the new one. You put, yeah, you're gonna put 80,000 in. You can pay that towards the credit card if you want, but why do that? Why not take your savings at $1,400 and instead of paying it to the bank, now you're paying it to the credit card each month? And then I figured out, well, then about 2 years, you pay off your debt. So that's another kind of example of how this works. Okay, so what does that do? I always like to say the debt load is 47%. So what I can do for that person is, in a couple of years, I can give them a 47% pay increase. It's like when I was working, did I ever get a 47% pay increase? Okay, so a couple more and we're almost done. So I mentioned before, I got a discussion, and actually I was introduced to this concept by a trader for Northwestern Mutual Insurance. When she found out the line of credit, she goes, well, that's just like a long-term care policy. Oh, yeah, it is. So I talked to one of my guys, and so when you have a line of credit, and especially say someone like Katie Karcher who's let it grow forever, guess what? If she needs in-home care, anything like that, she's got